Hello, everyone. Welcome to today's lecture on investment banking and lease financing. Today, we're going to start chapter number 8, which is financial engineering. And in this chapter, we basically will focus on what the concepts of financial engineering, how this financial engineering, such as how different types of financial engineering help investment banks to capitalize on the market movements and risks associated with those financial engineering, and how the associated risks in other conventional securities, associated risk of other conventional securities are taken care of by the use of financial engineering, and investment banks accordingly capitalize on this. All right, this chapter is a bit more advanced, and in that particular chapter, we will be discussing how different types of financial engineering tools, such as zero coupon bond, mortgage-backed securities, asset-backed securities, collateralized mortgage obligations, such issues will be discussed more in detail here. And don't worry, you know most of them. And if not, then the concept is, I will present those concepts as understandable as possible, okay? And you guys have mostly you guys have learned, or you guys know some of these tools here that will be discussed in this chapter. And if not, you will learn those concepts in a bit more detail in your next semester. All right. Now let me share my screen first. All right, as I said, today we're going to discuss concepts of financial engineering. First of all, what is financial engineering? It can be defined as the overall development and creation of some applications of financial technology to solve financial problems. All right. So what are those financial problems that here, in case, for example, the financial problems for investor is to choose the proper asset allocation mechanism, or to use appropriate tools, or appropriate, what should I say, appropriate components or appropriate assets to deal with those risk and asset allocation problems of the investor. Then these functions, as I said, the functions can be defined as a development and creation of applications using financial technology that can be used to solve financial problems, or exploit financial opportunities. And these financial problems, when in the process of solving the financial problems, those financial opportunities also arise, and financial engineering exploit those financial opportunities. And finally, those in the process of these solving financial problems using financial technology, and taking or exploiting the financial opportunities, eventually financial engineering adds value. All right. So some of the examples of financial engineering includes derivative instruments, zero coupon bonds, and in our country, the Islamic finance products. All right. And zero coupon bonds, recently zero coupon bonds are taken care of by several private institutions. For example, NAWOD, as you know the name, has intends to issue a zero coupon bond equivalent to 750 crore, if I'm not wrong. All right, then Standard Chartered Bank also have these kind of mechanisms too. As you see here, there are two sorry, there is something wrong in my sharing. Okay. All right. So two instruments that are used in that case of financial engineering is zero coupon bonds and mortgage-backed securities. Today we're going to discuss the zero coupon bonds in detail, or then we will discuss some part of mortgage-backed securities in today's lecture, and then the remaining part will be discussed in coming lectures. All right, zero coupon bonds and mortgage-backed securities are used as a source of financial engineering tool. One of the tools of financial engineering. They're the products of conversion arbitrage. By conversion arbitrage means investment bank takes one or more financial instrument and through composition or decomposition creates different sets of financial instrument that has financial instruments that have a more or less equivalent financial characteristics. All right. So in that process of conversion arbitrage, investment banks considers the or takes the advantage of conversion arbitrage. And I think you guys know the concept of arbitrage here. So and this conversion arbitrage means investment banks takes one or more financial instruments such as bonds and through composition and decomposition creates different set of financial instrument. All right, composition means you create different versions of financial assets that have different characteristics, and decomposition means you subsequently reverse the process and get back to the original securities in securities that are used to decompose the securities in turn. If you don't understand this concept, just don't be panic because these issues will be discussed more in detail in my in subsequent slides. Okay. So as I said, this decomposition of financial instruments are created in that case that has the similar common properties along with the assets from which the decomposition is made. And as I said, this process is converted by using conversion arbitrage, and this process is followed by investment banks heavily. And now discuss in detail about the concept of zero coupon bonds, and some of you understand, and some of you may know the concept of zero coupon bond. Zero coupon bond, first of all, as you know, unlike conventional bonds, or in conventional bonds usually pays conventional bonds usually pay periodic coupon payments and face value at the end of the maturity, given that there is no prepayment or call provision here. But in zero coupon bond, there is no coupon or interim periodic coupon paid by the issuer to the investor, and these zero coupon bonds are sold at a deep discount, and at the end of the maturity, the face value is paid to the investor, and this associated difference is the return created as the return from this investment. All right. So this is the concept of zero coupon bond, but its zero coupon bond are used in effective vehicle for, as you see, the achieving portfolio return objectives, hedging complex risk exposure, and structuring wide variety of synthetic instrument. B and C, point B and C here is are the major area of focus for this particular chapter. Hedging complex risk exposure, we will not discuss. We will discuss in that particular lecture how zero coupon bond eradicates or takes care of the potential risks associated or more present in conventional bonds. All right. And these zero coupon bonds are used to hedge against those risks. And once you structure a wide variety of synthetic instrument, we will learn in coming slides that how zero coupon bonds are used to create or create synthetic instruments for a conventional bond that has similar risk characteristics with conventional bonds, but with but the existence of these synthetic instruments sometimes eradicates or solves or take takes care of the potential risks available or present in conventional bonds. Okay, so the zero coupon bonds can be classified as three types based on nature of the issuer. The zero coupon bonds can be issued by treasury bonds, and which is much more common in the process of decomposition or stripping the bonds. Municipal zeros were issued by municipal bonds, and in that case, the issuer, as in that case, the investor gets the tax advantages. And the corporate zero coupon bonds are issued by private corporations, as I said just before in the previous slide, that in our country, Nagod is intended to issue zero coupon bonds, and Standard Chartered is the same. All right. So here I discuss what are the rationales of using zeros. Zero coupon bonds sometimes and are called zeros, and by zeros in the subsequent lecture I will refer to zero coupon bond. All right, there are many types of risks. Why zeros? As I said, zero coupon bonds control, or zero coupon bonds takes care of some of the risks that are present in conventional bonds. All right. So what are those risk factors that are managed by zero coupon bonds? All right. So as you know, some of the risks are interest rate risks, reinvestment risks, purchasing power risks, call or prepayment risks. So first start with interest rate risks, and these interest rate risks, as you know, what does this interest rate risks? And some of you may know that it refers to the change of price of the bond due to the unwanted change of interest rate. Okay, so these fluctuations of prices, because of the change of interest rate is referred to interest rate risks of bonds. Okay, so how does generally interest rate risk, as you know, that I think you people have learned the concept of duration. So duration is one of the measures that one of the tools that are used to measure the interest rate risks. Okay, so your bond duration in that case measures what will be the change of price of the bond due to a decimal change of interest rate of bonds. Okay, potential interest rates of bond. So this is one of the measures that measures the interest rate risks, and interest rate risks measures the change in price of bond to the change in interest rate. All right. So now the problem, the question is here: how can we deal with interest rate risks? There are several ways to do. There are several ways to manage the interest rate risks. First, first option is to match the maturity of the bond with the horizon, investment horizon of potential investors. All right. In that case, if the investor match the maturity of the bond with his or her investment horizon, then they can to some extent deal with the interest rate risks. But here, one thing that comes, present in that case is reinvestment risk. So if you try to match the interest rate risks, but your byproduct, you're generating reinvestment risks in that case. How is that? Because the periodic coupon received from the bond will be reinvested at a rate which is different from the rate that existed at the time of the purchase. All right, when you purchase the bond, you are eventually reinvesting the coupon payments at a rate which is different from what existed at the time when you purchase the bond. If that happens, consequently, what will be the end result? The end result will be that your end expected wealth is not same as your actual wealth. That means there is this difference eventually creates the difference of deviations between your expected wealth and potential expected wealth and current wealth. So matching in maturity and horizon may deal with the interest rate risks, but eventually that may not that may not insulate you from reinvestment risks. All right, we'll learn reinvestment risks in more detail in a few slides later. Second approach to deal with interest rate risks is to choose a maturity that is less than the investor horizon. In the first approach, we said matching maturity with horizon, and the second is to choose a maturity of the bond that is less than the investor horizon of the investor. In that case, what happens then? Rollover. In that case, the investors roll over the investment in subsequent shorter maturity investments, because your investments, your bond investment matures frequently, and then you can, as an investor, reinvest your reinvest your investment in another shorter maturity investments. So, for example, if your investment horizon is 10 years and you take positions of 2-year bond, then you roll over the investment and take another position of 3-year bond, then you take another position of 2-year bond. So you subsequently creates a sub-maturity periods of investments that are within your investment horizon. All right. When early liquidation is warranted, then this approach is useful. For example, if you what does that mean in that particular case? If you within the horizon, if you are in need of liquidation or early liquidation of your asset, then you are supposed to take positions of shorter maturity bonds, because in that case, your maturity of the bonds is within the horizon, so you can liquidate your asset whenever your liquidation needs comes into short-term horizon, short maturity period. All right. Furthermore, one thing that should be needed, should be added here is that you know that the short maturity investment is less sensitive to change in interest rates. Therefore, such short maturity investment immunes the investor against the interest rate risks. Okay, so because your maturity is less than your horizon, and you can take care of these interest rate risks, because the short-term investments are less sensitive to interest rate change compared to long-term investments, because the duration of the short-term investors are less than the duration of the long-term investment. And since the higher the duration, higher is the sensitivity of the interest rates to the potential price of the bond. Number 3 option is to deal with interest rate risks is to choose a maturity that is greater than the investment horizon of the investor. But how that can my question is, how can you as an investor deal with this problem here? All right, if you invest in a security that higher maturity than your horizon, then you take care of the extra maturity of the bond by taking potential, or by hedging your risks associated with extra maturity by taking position in derivative instruments such as forwards, futures, or swaps. So if you take or hedge your risks of those investment by taking forwards, for example, you lock the price of the bond for certain specific period, or futures, you can then you can take care of this you can take care of the potential interest rate risks. Okay, in all 3 cases that I discussed, just to here to deal with interest rates, such as matching maturity to investment horizon, choosing maturity that is less than the horizon, and choosing maturity that is greater than the investor horizon. But all these 3 cases, reinvestment risk is present. All right. Now it's your task to find out how those in reinvestment risk is present in all of the 3 cases. All right, so this is interest rate risks and reinvestment risks. Now, horizon as I said, uh, uh, the reinvestment risk is related in all of these cases, but to give you a hint about that, if you match horizon to maturity, then the coupons are reinvested with associated reinvestment rates. Okay, as long as there is requires reinvestment, then you should take care of the reinvestment risks. And since you receive your interim coupon payments, you don't put those coupons under a pillow. You just reinvest these coupons at the existing interest rate, and this interest rate might be lower than expected. When the maturity is less than horizon, then the reinvestment creates a subsequent rollover that are not known. All right, so you know that when your maturity is less than your horizon, you can get the first rollover coupon. You can terminate, you can liquidate the first set of investments, but you cannot know, you don't know the next potential investment return at the some particular right at the moment of the purchase rollover of the first maturity bonds. Okay, so there is potential reinvestment risks associated there as well. Now comes another that is not in the list here, but another risk that is present is default risks or credit risks. And this concept is pretty much simple. And you guys know that the default risk means the issuer fails to pay the interest and principal to the investor at the end of the maturity. Okay, so in that particular case, rating agencies play crucial role along with the market itself, because market itself plays a very crucial role to determine the potential default risks of a particular investment, okay, or particular investment of bonds. So, but apart from this, there are potential ways. I did not explain default risk in detail, or definition of default risk in detail, because you guys know the concept pretty well. But and here I discussed how to deal with default risks, and some of the mechanisms are also known to you. All right, so first of all, how to deal with default risks is to low risk of defaults. Invest in securities, investment bonds that has low risk of default, particularly the treasury bonds, treasury bills. Okay, or apart from these treasuries, you can also invest in good rating corporate bonds, good, highly rated corporate bonds. Okay, another option that that lies before you is all right. Another way, another option to deal with default risks or credit risks of the issuer is to diversify or use diversification technique. What happens in that case is the investors invest in a pool of low graded, high risky bonds whose overall risk is low. As I know that when you apply diversification technique in a portfolio of low graded high risk bonds, the overall risk will be lower. Okay, subsequently, if we assume the market is efficient, then the risk premium justifies the overall default risks will be well justified. That means if the market is efficient, which by market efficiency, you know that the price of all assets are reflected. The price of all assets reflects the all available information irrespective of the sub-classifications of market efficiency. And as you know, and as I discussed here, if the market is efficient, then the risk premium of this default risks, risk premium of those high risky bond investment justifies the default risk premium. Anyway, the bottom line, to summarize this issue, the bottom line is here that a default risk is minimized. A default risk of the investor is kept taken care of by investment in bonds that are high that had a high credit rating, or investment in treasury bonds or government sponsored bonds, or investment in a pool of low risk, high risk assets in which the default risk premium is justified by the diversification technique in the event of market or in the existence of market efficiency. Treasury securities can be an option, as I mentioned, who wants to immunize from interest rate risks and credit risks. Particularly if you invest as an investor in treasury securities, you can deal with both interest rate risks and credit risks in that case. How can you deal with interest rate risks in that particular aspect? Because the treasuries are available for different maturities in which the investors can match his or her investment horizon, and the availability of very sub-maturity periods of investments opportunities of treasuries. The investors can match his or her investment horizon with the potential maturity of the bonds, but there still exists a reinvestment risk, as we discussed in previous slides. The credit risk, as simple as you know, that the treasury sponsored or government sponsored bonds are supposed to have lower credit risk because the risk of default of government is very minimal, okay, or it's nearly impossible. But treasuries are exposed to reinvestment and purchasing power risks. See, even though treasuries tackle the interest rate risk, interest rate risks and credit risks, but they are exposed to reinvestment risks and purchasing power risks. The reinvestment risks can be, in that circumstance, the reinvestment risks of the potential treasuries can be removed by investing in zeros, because those zeros do not pay any interim coupon that has any reinvestment obligation or that has any reinvestment features or reinvestment opportunities. See, but on the other hand, furthermore, in that case, the treasuries, along with reinvestment risks, they're also exposed to purchasing power risks. The purchasing power risks can be purchasing power risk. First of all, purchasing power risk means the potential loss of potential loss of real value of interest and principal with the rise of inflation rate. All right, so purchasing power risk in that case can be addressed by inflation indexed bond. If you index the terminal value of the treasury bonds with the inflation, then your potential increase or decrease of inflation has associated effect on the price of the on the value of the bond. So indexing, in that case, investors who invest in zeros with matched maturity and horizon are immune to interest rate risks, reinvestment risks, and default risks. Okay, so investment in zeros, in that particular case, immune the investor in all of these potential risk factors: interest rate risks, reinvestment risks, and default risks. Okay, then comes call risks or prepayment risk. And I have discussed reinvestment risks here and purchasing power risks also. Then finally it comes call or prepayment risks. First of all, here I discussed the call risks. Call risks, in call risks, the investors are paid prior to maturity by issuer. It also stimulates the reinvestment risks. How? Since the payoff are subject to then interest rates. Okay, when reinvestment is considered. That's why the issuer proposes call premium when bond is called to the potential investor. So since the payment of the principal or interest of the bond is paid prior to maturity by the issuer of the bond, the investors in that particular case were exposed to substantial amount of reinvestment risks, because the payoffs are supposed to be reinvested at maybe at lower interest rates. Okay, so as I know that in that particular case, the investors claim a premium call premium that is well known in the finance literature. So there's call premium are sometimes warranted by investors in that circumstance. What then comes purchasing power risk, as I mentioned here, but to purchasing power risk, investment return is subject to fluctuations of inflation that just I discussed previous slide. One of the other benefits of zeros in that case, okay, one of the another reason that zeros are created here is non-callable. How can zeros or zero coupon bonds in that case deal with call or prepayment risks? But you know, the zeros are created from non-callable treasuries bond, so that the call risk is removed from the picture. So it also removes the purchasing power risks, as I mentioned, that because as I mentioned just a few minutes ago, that if you can remove the purchasing power risks if the terminal value is indexed to inflation. All right. So if you index the inflation, purchasing terminal value indexed to inflation, and it price is adjusted to the change in or fluctuations in inflation. In zeros, the tax payment is deferred. Remember, another feature of zeros. In zeros, the tax payment is deferred since the coupon payment is not paid. It allows the investors of zeros to take advantage of tax deferral by utilizing the funds that would otherwise be paid as tax. What happens here is, as I said, the tax deferral in that circumstance creates a very good avenue for the investors to reinvest or use the funds that have not been paid as tax. So this tax deferral, how the tax deferral happens? Because the coupon is not paid in that case. So since the coupon is not paid, the tax that would have been paid had the tax been paid, had the coupon been paid, this tax of the coupon is deferred, and this deferral creates a potential capitalized or potential use of funds by the investors, or this is often called the tax deferral funds utilization. Okay, now tax is paid, but this tax rule is changed in the US, where the tax is paid or accrued whether the tax is paid, whether the interest or coupon is accrued. Okay. Because of the potential risk management and tax benefit, IB or investment banks considers zeros a potential investment or financial engineering vehicle. Okay, what are the tax deferral? I discussed the tax deferral concept here, and as I said, the potential risk management, and the potential risk management comes in the form of interest rate risk management, reinvestment risk management, purchasing power risk management, call and prepayment risk management. So because of this potential risk management power of zeros and the associated tax benefit, the investment banks consider zeros a very good or handy vehicle of financial engineering. The benefits of zeros are reflected in the price, how and why the investment banks considers zeros as a potential investment vehicle, because the benefits of zeros are reflected in the price, and stripe of zeros created from conventional bond have a value greater than the bond from which the stripe is created. All right, if you don't understand what I have said, just recap my video. Okay, if the consequence or consequence of such thing is that the stripe, I refer the term here is striping. Stripe means you create a series of zero coupon bonds. Listen carefully. In striping, you create a series of zero coupon bond from a conventional bond in which the potential zeros have similar financial characteristics of the conventional bonds. Later in the lecture, we have a graph. I will explain this, but I will refer to this statement when I discuss this graph. Okay, so zeros reflecting the price of stripes. In that case, the zeros created from this striping from conventional bonds has a value greater than the bonds from which the striping is created or generated. Okay, so this is kind of, you can say, the synergistic examples, or you can refer to these understanding to synergy from mergers and acquisitions. But first point, why investment banks takes zeros as potential financial engineering vehicle. First point, as I mentioned, the zeros that are derived from the conventional bond has a greater value than the conventional bonds from which the striping is conducted. Number two, demand of zeros. What are the consequences of this? Since the value of the zeros is greater than the value of the bonds from which the value of the bonds from which the zeros are striped, what happens in that case? What is the consequence of such event? In that case, the demand of zero by investment bank stimulates the demand of bonds, because as the investment banks can earn larger profits by striping the zeros, in that case, the demand of zeros stimulates the demand of bonds. If the demand of bonds goes up, what happens? Consequently, such demand of bonds pushes up the price of the bond, and the higher price of the bond, because of the higher demand, lowers the potential yield. So consequently, government or treasuries objects to striping. Governments of, particularly in US, the government objects to striping. Why is that? Why do you think government should object to striping? Because government or treasuries subsequently initially objects against this striping because of the potential tax deferral. As I say, as I discussed this issue just a few slides ago, this potential tax deferral prevents government from getting the tax until the maturity. So government objects against this striping. But subsequently, as I said, the change of tax laws that allows tax to be paid irrespective of the interest rate is received or not by the investor, and government subsequently relaxes this restriction, and they create their own striping, which is called separate trading of registered interest and principal of securities, which has the name of STRIPS, STRIPS. You will get this code in your, you'll get the name of these securities in your text, but it has been created by governments in 1984, US Treasury governments in 1984, because of the associated benefits of these stripes is greater than the potential loss of tax. But the potential loss of tax is not happened here, because the subsequent tax laws have been modified by the governments later on, in which the tax is paid irrespective of the interest rates payment. Now comes zeros with conversion arbitrage. But first of all, but in this slide particularly summarizes the issues that I have already gone through. Treasury-based zero coupon bonds mitigate the risks, as I said, horizon maturity matching, reduce default risks, how the default risk is reduced by the zeros because you are because the zeros are most of the cases are generated from treasury bonds, which has no default risks, no reinvestment risks, because the coupons are not paid. uh, uh, a periodic coupon are not paid, and so the reinvestment risk is minimal here. Non-callable treasuries, because the bonds are created from non-callable treasuries, and the call risk is not there as well. And index to inflation, and these indexation to inflation often eventually reduces the purchasing power risks. Why did investment bank create zeros in that case? Striping of bonds create zeros can be a source of arbitrage profit for the investment banks. Revenues from market making. First point explains the point that I have already discussed. Striping bonds to create zeros can be a source of arbitrage profit for the investment bank, since the zeros created from this bank has created from the conventional banks. Sorry, the zeros created from these conventional bonds have higher value compared to the bonds from which the striping of the zeros have been made, and these will create an arbitrage profit from the investment banks. Secondly, revenue from market making is there because the investment banks act as potential broker and dealer of those zeros or the striped securities that has been created from the conventional bonds. Okay, more or less, specifically, revenue from market making means the investment banks being the dealer or broker of the zeros. General conversion arbitrage model. Conversion arbitrage, as I said, is an instrument that creates a set of instruments with different characteristics. Such characteristics may include such as cash flows, maturity, or tax benefits or tax consequences. All right, here you can say generic conversion arbitrage model, maybe input securities, securities 1, securities 2, generic. This is generic. From security and security, you combine or decompose input cash flows to create n securities here, output securities. Okay. But this, the point that the point of concern here is the conversion arbitrage model for zero coupon bonds. Our concern is zero coupon bonds. Look, input security is any conventional bond. Generation of zero coupon bond from conventional bond decompose input cash flows into output securities that has different maturity zeros. Look, n-year conventional bonds have been created to half-year zeros, 1 year zeros, or n-year zeros. This decomposition happens. For example, from a 3-year conventional bond, you can have 6 zero coupon bonds. From a 3-year conventional bonds that pays coupons semi-annually, you can create 6 zero coupon bonds. All right, you can create 6 zero coupon bonds, and from these 6 zero coupon bonds, you can create implied zero coupon yield. Why? I will explain that in later. First of all, deriving zero coupon yield curve. What happens usually that what happens normally that zero coupon yield curve before zero coupon yield curve. What does yield curve mean? A yield curve basically presents or depicts the yield against maturity. So it basically it's a plot of yield against the associated maturity. Maturity to yield is modified by yield to duration curve sometimes. Why is that? Because duration is more representative of risk than the maturity. All right, since duration, as I mentioned, it's a better measure of interest rate sensitivity. So, what happens if the conventional yield curve is imprecise? As you know, the conventional yield curve measures the time to maturity, plots yield against maturity, which is subsequently modified by duration to yield, but academics, this proposal of academics or empirical evidence is not that much popular. What proposes to represent yield against duration? It is not popular either. However, the conventional yield curve is imprecise. Conventional yield curve means what that represents yield against maturity is not that much precise or acceptable by the academics or the practitioners in real term. Why? Because yield maturity is not the sole determinant of yield. There are so many facts that determines the yield: government policies, inflation, and other risk factors. All other things remain determine the yield of the bond. So the conventional yield curve in that circumstance is imprecise because there are some other facts that are excluded here. If you run the regression against the yield to maturity of a very long-term investment horizon, you will get, most likely you will get R square value that is very low in that case, because the explanative power of yield by the maturity may be diluted by other facts here. All right, so we'll have another thing that should be clear before we discuss the bootstrapping. In that case, what happens? Zero coupon yield curve often is created as the spot yield curve. Okay, because the one interesting thing for zero coupon bond is that the duration of zero coupon bond is equal to maturity. I will not discuss the mechanisms or techniques to how to calculate duration, because that's the scope of other course, not this course. But usually you'll see that except zero coupon bond, in all of the conventional bonds, duration is less than maturity. All right. If you get something of duration higher than maturity, you have done something wrong in your calculation. You should better look for that mistakes. All right. But in conventional way, for conventional bonds, duration is less than maturity. But in zero coupon bonds, the duration and maturity are equal. Okay, but the implied zero coupon yield curve that is derived from conventional yield curve using the technique called bootstrapping. Bootstrapping means zeros are not as liquid as conventional bond. Therefore, before going through the bootstrapping, we should explain a bit about the spot yield curve and zero coupon yield, because zeros are not that much, is not that liquid as conventional bonds, and therefore the spot yield curve, which is spot yield curve, means when the when we get the yield curve using zeros, we'll sometimes that is called spot yield curve. Okay, so in that case, you should you should give a better concentration. This topic is a bit more confusing, and I will if you are not much clear about this interpretation, please recap my videos frequently. All right, as I mentioned, the spot yield curve, sometimes the zero yield curve from zeros are referred to as the spot yield curve. Here I explain, look for the term implied zero coupon. What does this mean? Implied zero coupon, before going through the implied zero coupon, have a look at the table. It shows the maturity, coupon, periodic coupon, and conventional yield. And the conventional yield, you know that is the required rate of return that equates the present value of future expected cash flows of the bonds to its market price of the bond. All right, this is called conventional, as you know, the YTM, or yield to maturity. Okay, you get the coupons, periodic coupons, and the yield to maturity, and the periodic coupons are half of the coupon rate because it's a semi-annual bond. Okay, as I said, there's striping. These conventional bonds are striped or decomposed to create series of zeros. Okay, and you may ask, why should I go for zero? Why should I create zeros here? All right, but the answer is that we have seen zeros have so many benefits. because zero coupon bonds take care of the risks of conventional bonds. Okay, there are so many risks associated with conventional bonds that are taken care of by zeros, and financial institutions and investment banks, investment banks, zeros among the investment banks are very much popular when they talk about financial engineering. Okay, so because of those risks are managed by zeros, and these zeros have very potential and lucrative attractiveness among the investors. Okay, so now come to the point that how implied zero coupon bonds again from these conventional bonds attributes, you create a series of zeros and you create an implied zero coupon yield curve for corporate bonds, for treasuries, for municipalities. You create the implied zero coupon yield curve from these conventional bonds, okay, and use the given coupon and conventional yield curve of these conventional bonds to create the implied zero coupon yield. Okay, so how this process, how that happens is I will go for, yeah, I discussed the bootstrapping, conventional yield curve, power yield curve. Yeah, the discussion has already been made. And how does zero coupon bonds are created from this table? But before that, I need I need a bit more information. I discussed what are the implied zero coupon bonds mean. Zero coupon yield curve means because it is created from the conventional features of the bond. Implied zero coupon yield curve is generated from a par yield curve. When the par yield curve means when you use the par value of a bonds, or in which the zero coupon bonds are implied zero coupon yield curve is generated from a par yield bond. The par yield bond means when the bond is traded near par, then you get the par yield curve. Bootstrapping is used to generate an implied zero coupon yield curve for treasuries and corporates, the point that I have already discussed, and I recap this statement. Then comes what, how is that, then I discussed the YTM, how can you get the conventional yield, and you have from an introduction to finance course, have learned how to determine the YTM, or yield to maturity of conventional bonds. All right, you see that when they're periodic coupon, zero coupon bonds, as I said, the for zero coupon bonds, as I said, the coupon rate and conventional yields are equal. Okay, you can see there is a statement there, as this statement has already been elaborated by me just a few slides ago. The conventional bond can be considered as a series of zeros. Okay, in other words, one conventional bond is basically a combination of multiple zero coupon bonds of different maturities. For example, 3-year semi-annual conventional bond is a combination of 6 zero coupon bonds of different maturity. By different maturity, I mean, for example, you can have half-year zeros, 1-year zeros, 1.5-year zeros, and then goes on like this. 4-year semi-annual conventional bonds, you will have 8 zero coupon bonds of different maturity. And this formula is nothing exceptional from the formula that you usually capitalized on during the calculation of YTM, because the price of the bond is the present value of all future expected cash flows, and subsequently use this formula to determine the cash flows while yield to maturity. Here we will discuss how can we calculate implied zero coupon yield, and maybe you have already learned about this, but if not, I will recap this calculation here, and just it's a very simple calculation. Okay, what happens here as a conventional bond 100, usually the price of bond is 100, assuming the price of bond is 100 by taking the conventional thoughts in consideration. All right, you can see first year, first period payment, the implied zero coupon yield is 8%. Okay, for 1 year maturity conventional bonds, you will have coupon payments of 8.25% and periodic coupon 8.25% divided by 2. Semi-annual coupon will be 4.125%, and conventional yield you will have is 8.25%. Okay. Now the numbers in purple are the implied zero coupon bonds that are generated from the conventional bond. Okay. Here, for the first year, you'll have 2 periods of payment. So the coupon payment first is 4.125 divided by first year's yield, which is 8%, and half of it is 4%. Plus, the second year will have coupon of 4.125 plus the principal payment of the bond, or the face value payment of the bond, which is 100 plus 4.125, which is 104.125, divided by 1 plus y2 divided by 2. What does this y2 mean? This y2 is basically the implied zero coupon yield. You don't know that. Okay, you know the conventional yield, but you do not know the implied zero coupon yield at time 1. Okay, so therefore you have to determine this y2, and by using a bit of algebra and by substitution methods, you will get y2 equals to 8.255%. This is what is called implied coupon yield or spot yield curve. Okay, so applying similar approach for third year, sorry, not third year, for third period, you'll have similar approach. For example, in third period, first coupon, your coupon payment is, periodic coupon payment is 4.1875 divided by conventional yield first year 1.04 plus second year coupon 4.185 divided by 8.25%. Half of 8.25%, you will have 4.125%. And third year, you add back coupon and principal payment, but you don't know the implied coupon yield. All right, this value is absent, and you know the conventional yield, but you don't know the implied coupon yield curve in yield. Okay, so you divide this, and you will get your implied coupon yield in third period, or after 1.5 period bond, you'll have 8.384%. That's a very simple calculation. Just go through the figures. That will be very much easy for you guys. Okay. All right, zeros. Before starting the next half of this lecture, this is what is implied zero coupon bonds, and these zero coupon bonds are used by investment banks in financial engineering, as we know that why and how this is used, how these zeros are used, and why these are used. I have already explained these issues. And zero coupon and apart from these, zero coupon bonds and zero coupon yield curve have become very much popular among the financial engineers. Both the initial value and payment at the end are known with certainty in case of zero coupon bonds. Okay, so conventional bonds, as I said, this process of financial engineering, the conventional bonds are decomposed into a set of or series of zero coupon bonds with different maturity, and subsequently from this you can get the implied coupon yield curve, and this process can be reversed in a way. How is that? The reversal happens when you, from a series of zeros, you recreate the conventional bonds. But the process is pretty much sensitive to the value and cost benefit analysis. What happens, it becomes profitable when the bond that is created from a series of zeros is priced above the cost of striping of zeros. Oh, okay. But the point eventually happens here that these mechanisms are sometimes investment banks like to play with these zeros in the event of financial engineering. They create, they recreate, they decompose, they reverse the process of zeros using treasury conventional bonds or treasury bonds or conventional bonds. And why these zeros are created, there are so many rationales that I have already discussed in previous slides. And this is the one of the tools of financial engineering. So the firms usually capitalize on the use of zero coupon bonds. Okay, the next part of the lecture is depends on the mortgage-backed securities. So in mortgage-backed, before discussing mortgage-backed securities, and you people have idea regarding regarding the concept of mortgage. So the mortgage is a loan secured by real property, real estate, such as buildings and lands. The definition, as you see the definition here. In that circumstance, there are two parties. One is mortgager, another one is mortgagee. In that case, one who wants to take or one who wants to borrow fund from the banks or financial institutions to finance the purchase of the real estate, he usually uses this real estate as collateral against the loan that have been secured from the banks. Okay, in that case, the borrower who's borrowers who use the real property against the loan is known the mortgager, and the mortgagee is he who pays or not pays. The mortgagee is he who lends the money to the borrower. Okay, usually the banks. All right. So these two parties are there in case of mortgage transactions. So mortgagers are the borrowers. In bottom line, the mortgagers are the borrowers, and the mortgagee is the lender in that circumstances. So there is a problem. The problem is that when banks do not have unlimited funds, all right, when they use some of their funds or like portion of the funds in lending to the borrower, so in that case, the funds become tied up in existing mortgages, all right, unless the mortgager repays the principal and interest, the mortgagee cannot, unless the mortgagee repays the loans, or the the mortgagee have different sorts of deposits, the funds are in that circumstance become tied up or stuck in existing mortgage. Thus, the bank is not able to create additional mortgage, excuse me, the banks in that circumstance are not in a position to create additional mortgage, as I said, unless the raises additional fund from deposits or the mortgager repays the amount or interest or principal to the mortgagee. Okay. So to solve this issue, what happens in that case is banks issue mortgage-backed securities. Okay, mortgage-backed securities, how that happens in that case, the mortgage, but before that, one point that should be noted is that the mortgage is serviced by mortgagee or the originator of the loan. Okay, since the fund existing mortgage is tied up to new mortgage, so the mortgager mortgagee cannot access to new source of fund. Okay, what if consequently to solve this problem, as I said just a few minutes ago, that the mortgage in that case issue mortgage-backed securities in which their mortgagee pool a series of mortgage and pool this mortgage, and they use this pooling to reissue securities and get potential funds. All right, you will be clear about this a few minutes later. Pooling and guaranteeing mortgage and the securities that are issued against the pools are called pass-through certificates in that case. I will discuss this, but before that, how does a mortgage work? All right, in that case, you have already learned that there is a repayment schedule. All right, repayment schedule or loan amortization schedule, if you guys have can recall this concept. But in that case of mortgage payments, if you go through the if you have any chance to go through or look at the mechanisms that the real estate and mortgages usually do in their circumstances, prepare a series of repayment schedule. All right, in repayment schedule that constitutes both the payments of the mortgage. The payments of the mortgage by the mortgager includes both the principal and interest payments. And as you know, at the initial payments, there is more interest than principal, but at the later payments constitutes more principal than interest. All right, so since the principal is the principal amount is repaid against in every payment of the loan, then it is often called the self-amortizing form of debt. All right, in conventional bonds, as I say, conventional bonds are fixed rate mortgage. I said bonds, not bonds. The conventional mortgages are fixed rate mortgage in which mortgage payments are of equal size. It is sometimes called label payment mortgage, as the payment is fixed all the time. And as I said, because since the payment includes interest and principal, it happens that the initial payment, as just I mentioned, payments include more interest and less principal, whereas the later payments include more principal than the interest. In that case, since the payment reduces the overall balance of the mortgage, it is often called self-amortizing bond. In that case, what happens, sometimes the mortgagee means the originator of the loan, gives the mortgager the option to repay the mortgage or make payments in excess of scheduled payments, such as excess payment reduce the mortgage balance, and this is often referred to as embedded call option. Okay, this facility provided by the mortgagee to the mortgager creates embedded call option for the mortgager. Because usually the payment is fixed, but if the mortgager wishes to pay in excess of this fixed payment, then that will reduce the mortgage payment, that will reduce the mortgage value. In that case, the mortgagee reduces the overall balance of the mortgage value, and such facility provided by the mortgagee to the mortgager will create an embedded call option facility for the mortgager. All right, for example, if your payment is fixed 500 and the mortgager pays in excess of 500, such as 550, this 50 will reduce the overall balance along with the principal payment in the label payment. All right, so this is up to the financial strength or stability of the mortgagor under this circumstance. Along with that, apart from level fixed payment mortgage, sometimes mortgagee or the originator of the loan uh, provides the mortgage with the opportunity to pay adjustable rate mortgage, which is sometimes called ARM. This adjustable rate mortgage, uh, under this ARM, the mortgage rates are sensitive to market conditions. All right, these rates are not fixed, rather it's variable. So in that case, what does mortgage do? In that case, to convince the mortgager, mortgage initiates a teaser rate. What does this teaser rate mean? The teaser rate is the teaser rate, the mortgagee sets lower initial mortgage payments or mortgage rates as opposed to level payment mortgage. All right, at this under the ARM, just to make sure that the mortgagee, just to make sure that the mortgage, not mortgagee, just to make sure the mortgagor are convinced to take this ARM facility or adjustable rate mortgage, the mortgagee sets a lower interest rates, sets a lower initial payment. All right, a lower initial payment than the level mortgage, and this lower initial payment is subsequently readjusted to match the market condition. All right, this lower initial payment is sometimes called teaser rate that I just mentioned, and this payment is subsequently readjusted with them to match the market condition with certain level of caps. All right, so there is a cap there, and you can say, all right, to the market condition is going up, so the payment is going up and up and up. No, these payments are sometimes are capped by certain margins. So with certain margins within the payment, their margins, these caps are applied within the payments or across the overall maturity of balance of the loan. Okay, so this is what is called adjustable rate mortgage, the process that allows mortgage to move mortgage of the balance sheet. There is a process allowed there. There is a process, as I said, in the mortgage, the funds are stuck in the mortgage, and the investment banks, sorry, not investment banks. In that case, the banks are not able to create additional funds unless they have additional separate alternative avenues of deposits or reinvestments of mortgage issues or another flow of funds. The process, in that process, there is a process that allows the mortgagee to move mortgage off the balance sheet. All right, how that can happen? Simply a simple basic formula. If you sell something, or if you have an asset of 200, liquid asset of 200 in your balance sheet, you can sell this 200 to another party and you remove this illiquid asset from your balance sheet. All right, so applying this very generic, very general understanding, in that case, using mortgage-backed securities, in that case, the process allows the banks to remove the illiquid mortgages from its balance sheet. How that can happen? You might have learned, you might have heard the name of a GNMI. That means it's a Congress-sponsored, US Congress-sponsored special purpose entity, which is sometimes known as PE. And this GNMI is the Government National Mortgage Association, GNMA. Sometimes it's referred to as GNMA. So this is a sponsored, this is government sponsored mortgage association that sponsors that gives guarantees, or that gives guarantees of payment of interest and principal in favor of banks. Okay, the we in that what happens in mortgage-based securities with Ginimai's specification, any mortgagee that fulfills the performance specification of Ginimai can issue pass-through certificates to investors on pro rata claim basis. What does pass-through certificate mean? You will see in the next slide. I will explain this later, but before that, I need to go through some theoretical concepts in that case. As I said, at the first place, Ginimai gives some specifications since it is government sponsored. And and any mortgagee that fulfills this specification of Ginimai can issue pass-through certificates, and through these pass-through certificates, the mortgagee can remove the mortgage from its balance sheet. Eventually, they just backed the mortgage and issues pass-through certificates to external investors, and that is why this is called mortgage-backed securities. So you use the mortgage to pool the mortgage and use this pool of mortgage to issue other securities, to issue these subsequent investment securities to external investors, which is called pass-through certificate. And this overall process is called securitization. Okay. So the mortgage can keep in that case, what happens, since you are servicing the mortgage, in that case, the mortgagee, you means the mortgagee, I refer to you as mortgagee. In that case, I refer to you as mortgagee, and the mortgagee in that case can keep the servicing right with himself or sell them to another institutions. Servicing, what does servicing means? In that case, servicing means administrating the mortgage. That includes receiving the payments of interest and principal, paying the tax to the tax authority, or foreclosure the assets in the event the mortgagor is unable to pay the principal and interest and periodically. Okay, in the event of failure, the mortgagee can sell the property and repay his loan under the circumstance. All of this is called servicing the mortgage. All right. So the mortgagee in that circumstance can retain the servicing right of the mortgage, or the mortgagee can sell it to other institutions. All right. Another fee that includes here is the Ginimai's guarantee. Ginimai in that case receive a guarantee fee from the mortgagee. All right. So the from the mortgagee. So so these two parts of fees, one that constitutes the servicing fee and the Ginimai's or the special purpose entities sponsorship fee, these two fees are deducted from the mortgage coupon payment to find out or to get the pass-through rate. So pass-through rate is equals to mortgage coupon less servicing fee less guarantee fee of the government sponsored or special purpose entity, fees of special purpose entity. All right. So as subsequently these pass-throughs these pass-through fees are calculated, it has become an usual practice to originate mortgage, pool them, and sell the pools. All right. So investors of pass-throughs are exposed to both reinvestment and prepayment risks. Before that, just have a look at the graph here. All right, as you can relate my discussion in that case. Look, the left circles represents the mortgagors. In that case, the mortgagors, the mortgage originators own servicing right. So the mortgage originators are the banks. So the banks gives the mortgage loans to separate parties represented by this circle. They get the mortgagee in that case get 10.75% of coupons in total from the mortgagors. They pool these mortgages. Mortgagee pools these mortgages and then sell it to Jinmai or the government special purpose entity. Sometimes they are called special purpose entity or special purpose vehicle, SPV or SPE, whatever the case may be. All right, they sell it to Jinmai and Jinmai gives the guarantee of the pool because they are community sponsored mortgage association. So they give the guarantee of the pool, and given this guarantee, they receive 6 basis point payments, and this servicing of the loan of servicing of the mortgage constitutes 44 basis point. All right, as I said, from 10.75%, you deduct these 2 service fees, one from the guarantee of the Jinmai and another is the servicing cost that the originate to service the mortgage is deducted from this from the mortgage coupons to get the pass-through holders return. In that case, 10.75% minus 0.5%, you will get 10.25%. They pool these mortgages and they issue pass-through certificates against the pool of this mortgage. And that's why it is called mortgage-backed securities. You back the mortgages to these pass-throughs are the mortgage-backed securities because the pass-through certificates are created from a pool of mortgages. All right, and these and subsequently, since you are as a bank, since you have no since you in that process mortgagee removes the illiquid mortgage from his balance sheet, and they access additional source of funds by issuing pass-through certificates to investors by pooling the mortgages. All right, and that's why it's called mortgage-backed securities. All right, so what in that case the pass-through holders or the pass-through certificate investors in that case are exposed to kind of reinvestment and prepayment risks and interest rate risks. All right, so investors are exposed to reinvestment, prepayment, and interest rate risks. Since mortgages, how this happens? Since mortgages are self-amortized debt, as I mentioned earlier, this mortgage is self-amortized debt. The periodic payments of mortgage under the self-amortized debt are larger than those of non-amortizing conventional bonds. All right. So in that case, since the payments of the self-amortizing periodic mortgage loans are larger than those of the non-amortizing forms of debt, these higher payments are subject to reinvestment risks in that case, because the periodic payments periodic higher payments are reinvested at a rate that might be lower than expected. Another thing that is prepayment risks. In that case, some of the mortgagees provides the mortgagee with the opportunity to prepay the principal or prepay the loan earlier than the maturity. Sometimes this prepayment can happen because of the liquidity needs of the mortgagor, because of the death of the mortgagor, or the mortgagor in that case has an option to get the financing done at a lower rate. All right, if this is one of the most prominent reason in that case, what that happens when the mortgagor has the option to refinance the mortgage at a lower rate, then he or she can liquidate his or her early mortgage contract. So in that case, he prepays the mortgagee the principals, and prepays the mortgagee the loans, and this prepayment from the mortgagor is passed through the investors or the pass-through certificates. So the pass-through holders in that case are forced to take the money prior to the maturity, because the mortgagor may have some other issues. They have some liquidity issues. They have some refinancing issues. They prepay to the mortgagee, and mortgagee passes this prepayment to the pass-through holders, and the pass-through holders in that case are exposed to prepayment risks, since they are about to reinvest that. This prepayment risk stimulates the reinvestment risks, because the pass-through holders in that circumstance might have to reinvest these funds at lower than expected interest rates. All right. So these are the cases, these are the problems that might be associated with pass-through holders. And these are the mechanisms of mortgage-backed securities in that case. All right. If you guys have understanding of all of these issues, and if you guys listen to the lecture very carefully and then read through the text, you will have a very good grip of the financial engineering that have been discussed today in terms of zero coupon bonds and zeros, and then mortgage-backed security, and a few part of the mortgage-backed securities. All right. So today, to summarize today's lecture, in just 2 minutes, we have started with zero coupon bonds, why these zero coupon bonds are used, and how zero coupon bonds reduce the potential risk of conventional bonds, and what are the potential yield curves that are associated from a series of conventional bonds, right? How the zero coupon bonds are constructed out of conventional bonds. Later on, we discuss the mortgage-backed securities and the concepts of mortgage and the associated payments of the mortgage in terms of loan amortization schedule, and why do banks use mortgage-backed securities in that case. And as we have seen that they use these mortgages they pool these mortgages, and they take the advantage of these mortgages to issue pass-through certificates to investors to remove the illiquid mortgages from the balance sheet. All right, these pass-through issues are the consequences of those mortgage-backed securities. All right, these mortgages are used to hold back to take advantage of these pass-through certificates, and these pass-through certificate holders are exposed to certain level of risks, such as prepayment risks or reinvestment risks in that case. All right. Thank you very much. Listen to the lecture. We'll have the next part covered in subsequent lectures.